This video is for educational purposes only. This is analysis, not financial advice. The 1929 crash was preventable, but almost nobody saw it coming. The terrifying part is the exact same pattern is repeating right now in 2025. 4 specific steps always happen before a collapse. Step 1 happened in March 2024. Step 2 in January 2025. Step 3 just wrapped up 3 weeks ago, which means Step 4, the final cascade, could begin at any moment. And what makes this terrifying is that almost nobody realizes the window has already opened. Here's something you can verify yourself right now. Warren Buffett quietly shifted $347 billion into cash in 2024 and 2025. That's not normal portfolio management. That's the single largest defensive position in Berkshire Hathaway's history. And here's the part the media completely missed. He did it quietly, without fanfare, while everyone else was cheering the bull market. Go back to September 3rd, 1929. Markets hit an all-time high. Newspapers declared a new era of permanent prosperity. Economists said boom and bust cycles were finished forever. Technology was changing everything. The story was simple. Wealth was being created at record speed, so why wouldn't markets keep climbing? But beneath the surface, something very different was happening. The Rockefellers were liquidating positions. Joseph Kennedy was moving to cash. These weren't public warnings. They were private decisions made by insiders who knew the game was ending. And if that sounds familiar, it should. March 2024, the S&P 500 crossed 5,200 points for the first time in history. The narrative was identical to 1929. A new paradigm, the AI revolution, the rules don't apply anymore. And just like 1929, insiders were selling while retail investors piled in. Executives dumped $47 billion in stock in the first quarter alone, 4 times what they purchased. At the very same time, Buffett increased Berkshire's cash by $42 billion. While regular investors celebrated, the elite were walking out the back door. That was step 1. Euphoria at the top, quiet exits underneath. And it ended in March 2024. Now here's where the pattern gets dangerous. In 1929, margin debt exploded. Ordinary people were borrowing $9 for everyone they owned just to buy stocks. The logic made sense while markets climbed, but leverage cuts both ways. It amplifies gains on the way up, and it obliterates accounts on the way down. When the market turned, those margin calls created a chain reaction that couldn't be stopped. Fast forward to January 2025. Margin debt crossed $1 trillion for the first time in history. By August, it hit $1.06 trillion, a new all-time high, up 33% in a single year. $1 trillion borrowed just to gamble in stocks. But it wasn't only individuals. Corporate America matched the madness. American companies owed $12.7 trillion, and much of that debt wasn't used to innovate. It was used for buyback, borrowing money to buy their own shares and push prices higher artificially. There are 3 reasons this is toxic. First, over-leveraged companies can't support their own stock prices when markets turn. Second, debt must be repaid no matter what happens to earnings. Third, much of this borrowing was locked in when interest rates were near zero, and now it needs to be refinanced at much higher rates. That's step 2. Leverage stretched beyond safety, and it ended in August 2025. So what comes next? This is the stage almost everyone misses. After the euphoria and the leverage, there's always a denial phase. In 1929, after the market peaked, prices didn't collapse immediately. They dipped, then bounced back. Each time, officials reassured the public. Federal Reserve Chairman Roy Young said the economy was strong. Treasury Secretary Andrew Mellon called the corrections healthy. And every recovery restored confidence. People thought the warnings were nonsense. They believed everything was fine. Because in September 2025, just 3 weeks ago, the S&P hit another all-time high. The August pullback was dismissed as a healthy correction. The narrative was the same. By the dip, the system is fine. But beneath that optimism, the cracks were everywhere. Margin debt was at record. Buffett's cash pile had grown to $347 billion. Credit card delinquencies hit 11%, the highest since 2012. Personal savings rates collapsed to 3.5%, the same level seen right before the 2008 crisis. The denial was in full swing, and Step 3 just ended, which means we're here. Step 4, the cascade. October 1929 began with a Thursday drop of 11%. The recovery attempt failed. Then came a 13% crash. The next day, another 12%. In 3 trading sessions, the market lost over 30% of its value. But here's the part most people don't understand. It wasn't triggered by one event. It was triggered by recognition. The collective realization that valuations had disconnected from reality, that leverage couldn't be sustained, and that insiders were already gone. Once that recognition spread, the selling fed on itself until nothing was left. And that's the window we're in now. 30 to 90 days after Step 3 completes, Step 4 historically begin. We're already inside that window. Not approaching it, not preparing for it, inside it. The trigger could be anything. Disappointing earnings that reveal the AI hype isn't paying off. A geopolitical crisis that shatters supply chain. A surprise spike in inflation that forces the Fed to raise rates. Or no event at all. Just the moment the public realizes insiders have already left. Once that realization spreads, the cascade begins. Here's what the smartest investors understand. It's not about predicting the exact date. It's about positioning before the collapse. Buffett didn't move hundreds of billions into cash because he enjoys missing gain. Ray Dalio isn't allocating to gold because he's a doomsayer. Bill Ackman, Carl Icahn, Leon Cooperman, they're not pulling back because they like sitting still. They've all survived crashes before. And they all know the same rule. You don't wait for the storm to hit. You prepare while the sun is still shining. The final piece of the puzzle connects everything. In 1928, regular investors stayed fully invested, convinced the boom was unstoppable. The wealthy rotated defensive. They gave up the last bit of upside to avoid the first devastating wave of downside. And when the crash came, they were the only ones left with the capital to buy. They scooped up businesses and assets for pennies on the dollar. They built generational wealth from the wreckage. That's exactly what's happening now. The insiders are rotating out while retail money floods in. The data is screaming warnings. The denials are louder than ever. The pattern is identical to 1929, and the window for Step 4 has already opened. So the real question is not whether this crash is coming. The pattern has already spoken. The only question left is whether you're prepared for what happens next. Because crashes don't destroy wealth, they redistribute it. And right now, the redistribution has already begun.